Thank you, Adam, and good afternoon, good morning, good evening, wherever you are in the world. And my name's Derek Langston from SSY Consultancy and Research, presenting today about the dry bulk freight market. And it's an extraordinary time to be talking about the dry bulk freight market because the first quarter of 2021 has seen the market for Panamaxes, Supramax, and Handies reaching the highest levels since 2010. Also, for the largest sizes, the capes, for the iron ore and the coking coal trades, we've actually seen some counter-seasonal strength at a time when normally the Q1 volumes, the lower volumes of iron ore from Australia and Brazil tend to diminish cape-size demand in the Q1. This year, as we speak at the moment, the market is pushing higher. So it's an extraordinary time for dry bulk freight market. The key question is, can this be maintained? What's driving this current strength in the market? And then with a view beyond 2021, what are the next regulatory steps for shipping? Just come through low sulfur, a major transition for the industry at the beginning of 2020 in terms of marine fuel. Now we're entering an era of decarbonisation legislation. So we'll talk about what's coming up and how that's likely to affect the market towards the end of the presentation. But firstly, looking at this chart here for Supramaxes, a 58,000 deadweight vessel. So really those vessels that will be carrying some of the iron ore from India, some of the steel around Southeast Asia. And this is the seasonal look at the average for the whole sector. And as you can see, there's a bit of seasonality in the Q1 normally. That dip that you see around February, kind of end of January, beginning of February, usually coincides almost exactly to the day with Chinese New Year holidays, such as the importance of Chinese demand to the dry bulk freight market. This time round, though, very different, almost 180-degree difference in the market. Instead of dipping, the market actually gained strength through Chinese New Year at the beginning of February, and that strength there pushing up towards $24,000 a day. If you adjust it to previous indices, as I mentioned at the beginning, the highest level since 2010. What's also important is a lot of this strength has been in the Pacific region as well. The cape-size market, well, as I mentioned at the beginning, tends to be a bit of a seasonal lull in the Q1 before more iron ore availability from Australia and Brazil kicks in, and towards June time, tend to get the higher volumes there. As you can see in this chart, that's been the pattern of recent years. Now, during February, it did seem that the cape-size market was beginning to edge down following those seasonal trends. But the strength of the smaller sizes, as we've seen there, actually meant that capes became more competitive on a number of cargoes. So some of the coal cargoes that would be carried by Panamaxes from East Coast Australia, for example, more likely to be carried by more price competitive capes. This actually, extending this around the world, actually helped give the cape-size market a bit of extra resilience. And with more iron ore availability from Brazil beginning to emerge, enabled the market to push up. So capes have been carrying, instead of the normal iron ore, a bit of bauxite, a bit of coal as well. There's been a wider variety of cargoes being carried, some grain cargoes being carried, limestone even, and even one remarkable fixture involving logs from Uruguay to China being reported. So very strange times for the shipping markets. Looking at the dollar per ton on these key cape-size iron ore and coking coal freight rates, you can see there the volatility in the market. From looking at that peak in 2019, when the Brazil-China freight rate was around $28 per ton, it has got down to levels of almost down to $7 per ton at the beginning of 2020. And at current levels there, we're sort of moving upwards around $23 per ton. But so there is that volatility. We're not back at those peaks of 2019, but this is, for this time of the year, this is certainly an unusual strength in the cape-size market. And then we'll go back to the Supramax market, in particular, focusing on Southeast Asia and looking at the Indonesia to East Coast India and Indonesia to South China round voyage rates. And we plotted them against the sector average here, the time charter average for Supras in black. And you can see there that normally they tend to underperform the sector average, higher rates in the Atlantic, structurally the case, but really in recent months there's some exceptional strength in those voyages into China in particular from Indonesia. So as really the market in Southeast Asia is really experiencing the brunt of the higher freight costs at the moment. So looking at this Q1 market strength, what's been driving it? Well, in terms of cargoes, one of the main drivers across the board, particularly for Panamaxes, has been the strength of US soybean exports, a real revival, which has been driven by swine fever outbreaks in China diminishing. They had affected the pig herd quite dramatically, driven down demand for animal feed. And as one of the main long-haul drivers of Panamax trade, been fairly significant. This time when we've had a revival in demand, strong soybean prices, strong corn prices as well. So there has been a change there. More grain than we've seen in previous years at this time of the year. Seasonally, that has been the case. It's benefiting with the US. Now we've seen more corn moving from the US, and also Brazil's main soybean export season is getting started. That's involved some congestion as well. And that has been absorbing Panamax tonnage. And this has been also been filtering it down into some of the smaller sizes. So the port congestion that we saw in China at the beginning of the year unwound in February, but at the same time built up for Panamaxes in Brazil. Bit of temporary disruption caused by Suez Canal, but in the end, that wasn't such a big driver. There were more ships being waiting off Brazil than in the Suez Canal. The Capes have become more competitive against smaller sizes. We've seen an industrial recovery involving restocking in the steel sector. And there's been some opportunity for longer haul coal trades as a result of China's stance on Australian coal, avoiding Australian coal imports. And this has actually led to more shipments there from North America of coking coal and some extra on steam coal from South Africa, for example. So some long haul coal trade alternatives. And another one for the smaller sizes that we've seen has been container shortages in the container market. So this has actually meant that the high costs of container ships and just a shortage of containers has actually pushed some of these cargoes. So that could be, for example, fertilizer, sugar, anything sort of potentially bagged or palletized could actually be moved as break bulk and go on to some of the dry bulk carriers. So that's been one of the factors as well. But in Southeast Asia in particular, we've seen more recently the growth of steel exports from China alongside some more fertilizer movements, taking tonnage away from the Pacific, so helping to reduce tonnage supply in the Pacific and push market levels higher there. Also as well, the continuing flow of Indian iron ore into India, Indian iron ore into China, cement from Vietnam into China, as well as nickel ore from the Philippines into China, all driving the market there and creating some very firm rates indeed. Just a couple of quick charts then to demonstrate this strength. They're showing here weekly US grain exports. And you can see there that how for a number of months, it's almost been really US grain exporters running at full capacity, particularly soybeans there in red. That started to diminish in recent weeks, but you've got very good eyes. You can see there that the corn exports there in blue rising. We're getting some very strong numbers there, over 2 million tons in a week. That is exceptional and one of the highest levels that we've seen since the 1980s. And looking at the Cape-size market, turning that now, mentioned the competitiveness against Capes as being one of the key features behind the higher freight market, but also looking at some of the iron ore flow from both Australia and Brazil has been a bit more positive than this time last year. Perhaps not so much in the way of weather-related disruption or some of the operational difficulties mentioned by Vale at this stage last year. We've also got the restart of Samarco, potentially more addition there from CSN, as well as the return of previously idled Vale capacity, pushing that 1Q number up over 10 million tonnes year on year. Looking at this year, summarising the dry bulk trade outlook, we see that we have a real rebound from the 2020 levels. Now, importantly for 2020, that contraction there is largely due to a fall of over 100 million tonnes in coal trade. We did see, of course, that positivity in iron ore, further growth there, some recovery, partial recovery in coal, further growth in grains and involving key minor bulks, supporting at the same time as the world economy is recovering. And it could well be, and we're looking at some of the GDP forecasts from the IMF and from the OECD, and it could well be the case there that shipping is actually reflecting that recovery in the economy and also the industrial recovery. That's been something that you'd expect to see most evident in the smaller sizes, which carry a greatest range of cargoes. So sometimes shipping here acting as a useful barometer of trade. Net fleet growth in 2021 is still expected to be in a sort of region there of 2 to 3% for some of the largest sizes, but for the handies, still fairly modest growth there. And overall, a generally positive picture then for trade. Looking at the overall picture then for new buildings, slower growth than we've seen in 2020. And at the same time, the order book, crucial to this picture here in red, you see that order book there by the end of 2020. That's the lowest level that we've seen in volume terms since 2003. And as we point out here in blue, lack of scrapping in recent years has meant that the shipping fleet's beginning to get older as well. And this is an interesting question because it leads into some of the decarbonisation measures that are taking effect in shipping at the moment. Mechanisms already been set out by the shipping authorities, the IMO, International Maritime Organization, to meet a 2030 target already now exist for new building vessels already in place. From 2023, there'll be an energy efficiency index for existing ships, and there'll be various measures in place there to gauge and measure operational efficiency starting in 2023. Now, we don't know the exact terms of this as yet. We don't know the exact requirements, how it's going to be enforced, what the penalties are likely to be. But for some of the older fleet, less fuel efficient, this will actually mean that you may need to slow steam in order to meet some of these requirements. So the implications then from decarbonisation are as follows. We have these targets, we have the regulatory framework in effect. There may also be market-based measures. These could take the form, as being proposed already, as levies on fuel. Also, the EU will be adding shipping to its emissions trading system from the 1st of January 2022. And there could be other authorities around the world that decide to have similar emissions trading systems and add shipping into that as well. There's also great uncertainty at the moment. When you look beyond the 2030 target, if you want to order a new building, you have to think beyond 2030. And there's uncertainty on financially viable new building designs. What is the optimal design for the future? Will it be using fuel oil? Will it be using an alternative such as LNG? Or LNG, of course, is not a full zero carbon answer by definition. It's a useful transitionary fuel. Or what will be the future for these vessels? So, as I mentioned there, we already have implications on slow steaming some of the fleet, so making the fleet less efficient in order to comply with some of these new standards starting in 2023. There's scrapping implications, because if you're not going to renew your fleet, if you're not sure what a vessel is the optimal design, you don't really want to scrap at the same time as well. And that longer term future, what is the fuel of the future? Is it, as Fortescue have already been linked with in the shipping press, with looking into designs to use green ammonia? So taking ammonia, the production of the ammonia to make it green ammonia would involve using renewable energy, lots of energy involved in the electrolysis, and that would be from renewable sources. You'd have a green ammonia option. So the technology exists. It's just a question of scaling up. And that's really a question for looking beyond the 2020s into the 2030s. So shipping really at the moment is embarking on another major change. So in conclusions then, we've had market fundamentals transformed at the beginning of 2021. The grain trades, coal market dynamics in China have been to the fore, along with this cross-commodity price strength. That Chinese coal market, record volumes moving in December. Still fairly strong volumes currently, but that's potential for that. Any import controls in the second half of the year could represent a downside risk. There is still scope for long-haul trade growth. China's grain imports, for example, as I've mentioned, more corn to come into China, and those trades from the Atlantic on Cape sizes. Role of fleet inefficiencies, including port congestion, which is currently building at Brazil's grain ports, that could offset the negative impact on the freight market from continuing net fleet growth. And then there's that longer term focus on decarbonisation. So I'll be delighted to take any questions you may have. Many thanks for your attention. Thank you.